Okay. Assalamualaikum warahmatullahi wabarakatuh. We are from Group 5. We will present the result of our discussion about the material audit risk base. Before moving on to the topic of discussion, let me introduce the members of our group. First, there is Ananda Putri Nabila, Jeremia Prilianto Maldin, Maria Wong, and me, Nadratul Hikmah. Next slide, please. Next, after studying this material, later we are expected to understand the 10 learning objectives that exist. Next slide. First one, we will find out why is a risk-based approach and aid to auditors. Next, first, let us know about the definition of risk-based audit. Risk-based audit is an examination methodology used to provide assurance that risk has been managed within the risk limits set by management at the corporate level. Notes that can be learned from this definition are: first one, auditor must obtain reasonable assurance financial statements are free from material misstatements reduce audit risk. The second one, auditor is not expected to give absolute assurance. Next slide. The primary objective of the audit risk ISAs are for auditors to identify and assess the risk of material misstatement at the financial statement level and the assertion level for class of transaction, account balances, and disclosure. Next slide. Auditors identify and assess risk of material misstatement at first, risk of material misstatement at the financial statement level, refer to risk of material misstatement that relate pervasively to the financial statement as a whole and potentially affect many assertions. And then second one, risk of material misstatement at the assertion level refer to risk of material misstatement of individual transaction, account balance, and disclosure. Next slide. There are three audit risk components. First one, inherent risk. Inherent risk is the susceptibility of an assertion to a misstatement that could be material, assuming that they are not related to the controls. The second one, control risk, is the risk that a misstatement that could occur in an assertion and that could be material will not be prevented or detected and corrected on a timely basis by the entity's internal control. And the last one, detection risk, in the risk that the auditor will not detect a misstatement that exists in an assertion that could be material. Detection risk is a function of the effectiveness on an audit procedure and of its application by the auditor. For the next presentation, we'll present by Ananda Putri. So Ananda Putri, thank you.
Okay, next about the broad approach to minimize audit risk. Next slide, please. First is investigate legitimacy of the entity and the integrity and the competence of the management before acceptance of the audit assignment and before subsequent audits. Second, consider the independence of the audit firm and the staff before acceptance of the audit assignment and before subsequent audits. Third, understand nature of the entity and its environment before commencing detailed audit work. Fourth, auditor plans to minimize risk of failing to detect material misstatement at the financial statement and the assertion levels. And fifth, design audit approach on the basis of what is known about audit client, set performance materiality from engagement team with the required experience and skills. And the last is perform audit programs to obtain evidence necessary to form conclusion at the assertion level, leading to opinion on the truth and the fairness of the financial statements taken as a whole. Next slide, please. Risk-based audit step from ISA-based auditing. First is risk assessment, second risk response, and the last reporting. Risk assessment. First, partners and the audit core team are actively involved in the audit plan. Second, professional skepticism in the pursuit of the reasonable assurance. Third, the audit plan include the time in the audit plan to ensure the audit objectives are met. Next, about audit team discussion and ongoing communication. Next, focus on identification of the relevant risk. Next is intelligent evaluation of the management response to risk. And the last is professional judgment in the client acceptance, develop audit strategy, materiality, develop analytical procedure, and the special audit consideration required. Next slide, please. Is about the risk response. First is test of control. We must to find identification of the relevant control that if tested could reduce the scope of other substantive procedures. However, there is no requirement to test the functioning of the internal control, direct or indirect, and also must identify any assertions that cannot be addressed by substantive procedure alone. And next about the substantive analytical procedure. This is a procedure by which the total amount of the transaction flow, for example, is sales, can be estimated with sufficient precision based on the available evidence, and the expectation or the estimate are compared with the actual or sales amount as recorded in the books, and the difference or misstatement is immediately identifiable. And the third, unpredictable examination. In the certain case, the auditor may need to include an element of the unpredictable in audit procedure. For example, when the responding to the material misstatement due to fraud. Fourth, the management override. The auditor also consider the need for the specific audit procedure to address the possibility of the management overriding or management decision to remove or override control by making exception. And the last is about the significant risk. Next slide, please. Reporting. Formulate an opinion based on the evidence obtained, prepare and issue appropriate reports according to audit conclusions. If all procedures have been carried out and achieved, then the audit findings are reported to management, and the audit opinion is and the decision regarding the appropriate editorial for the report made by the auditor. Next slide, please. Business risk approach to audit. Business risk is the risk that the result from the significant condition, event, circumstance, action, or inaction that could affect the entity ability to achieve its objective and execute its strategy, or from setting goals and strategy that are not appropriate. For the next slide, will be presented by Jerry. Jerry, time is yours.
Thank you, Putri. The next slide is about similarities in approach to business risk and inherent risk. First one, the approach to business risk and inherent risk by either management or auditors use a top-down approach where initially management or auditors consider the entity as a whole before they decide what steps are needed to prevent the company from achieving its objective, or in the case of auditor, to decide what procedures should be performed to ensure that the financial statements provide a true and fair view of the financial result and position. The second, factors that increase inherent risk, such as lack of management experience and lack of skills and other negative entity level factors, may reduce the likelihood of achieving business objective. The third as factors that increase control risk, such as a poor control environment, can also hinder the achievement of business objective. For analysis of business risk and inherent risk can assist auditors in work designed to prove that the financial statement provide a true and fair view. Both types of analysis provide the auditor with a better understanding of the entity and its operation. Next, about differences in approach to business risk and inherent risk. First one, the main difference is that auditors consider the inherent risk in relation to the impact they may have on the financial statement, whereas the business risk approach considers the risks that prevent the company from achieving its objective. Many company objectives may have little or no effect on the financial statement. Second one, while it is true that factors that fail to reduce the impact of inherent risk may also fail to reduce the impact of business risk, the objective of business and auditing are so different that they cannot be considered to create similarities. Next, about the impact of the business risk approach on the audit process. First, improve basic audit of financial statement and reduce the possibility that wrong conclusion will be reached about the state of affairs of the company and result of its operation. Second, audit are more efficient and therefore more profitable. Third, extend the potential to provide assurance to management beyond traditional auditing and is perceived to add value to the audit from the client's perspective, then thereby create an additional source of revenue. Fourth, extended audits have the potential to contribute to the regulation and disclosure of corporate governance due to a broader understanding of the business and its risk. Fifth, better understanding of the client's business and its risk will reduce the firm's own business risk, sometimes referred to as engagement risk. Next, the business risk approach and smaller clients and smaller audit firms. Business risk approach needs wide variety of expertise within firm to identify business risk and allow dialogue on equal terms with expert in client company. Business risk approach most appropriate in the audit of large multinational companies by the big four audit firms. But business risk approach is about attitude of mind on auditors' part involving acquiring knowledge about business rationale. Small audit clients doesn't usually have wide expertise in, and smaller audit firms may usefully discuss business risk with management as an aid to them. This means that firms other than large firms might be able to use business risk approach. Wider approach more expensive, but benefit could exceed cost. Next, about analytical review as a risk analysis tool. Analytical review are useful when the auditor is deciding where the risk areas in the client company are analytical procedure. They are important aid in reducing overall risk, in particular reducing detection risk. Next slide will be presented by Maria.
Okay, thank you, Jerry. So the next slide is about the judgment in accounting and auditing and its relationship to risk. So judgment is intangible in its nature, and the relationship between audit judgment and risk is direct, as it is exercised in the context of risk. In forming judgment, auditor makes initial risk assessments and then modifies them on basis of controls in existence and of the validity of figures in the accounting records. Any assessment of risk involves judgment. Auditor judgment exercised in context of audit evidence collected and evaluated. Next, please. So here there is two objectives of audit process management. The first objective is that meeting the professional aim of reaching a careful formed opinion on financial statement as required by law or by special instruction, and requires the audit firm to act effectively and to perform professional work of high quality. For the second objective is that making a profit in carrying out your professional duties sufficient to give fair remuneration for the imaginative and demanding work required in the audit process and for the professional risk involved. These objectives require the audit firm to act efficiently as well as effectively. Next. So in the third part, we will talk about the reference terms for provisions of the audit framework. Next, please. The first one is to whom the letter should, to whom the engagement letter is addressed. So the letter should be addressed to a person having management authority in the entity. And for the second is audit objectives and scope. In this section, it identifies the financial statements and states that the audit will be conducted with the objective of expressing an opinion on this statement. And the scope of audit means that the auditor will be doing in order to form reasonable conclusions in the course of an audit of the financial statements of the company. For the third part is the audit responsibilities. There is the first reference to the ethical standards to which auditors must adhere. The second, an explanation of the audit process, including planning and a reference to the fact that the audit is about obtaining reasonable assurance of whether the financial statements are free from misstatements. There is also a reference to how the audit will be conducted. And the last is the disclaimer regarding the entity internal control. Next. For the fourth one is about the responsibilities of management and those charged with governance. So here, the auditors inform management and those charged with governance of their responsibilities and ask them to acknowledge and understand that they have responsibility for preparing financial statements that are fairly presented in accordance with IFRS standard, including IAS standards. For the fifth is the audit reporting. There might be a reference here to the fact that the form and content of the audit report would depend on the outcome of the audit work performed, and that the draft audit report would be discussed with management before its issuance. Next is the sixth one, the cost or fee. Normally, the letter will contain details of how audit costs or fees are calculated based on time spent by members of the engagement team, the rates depending on their responsibility and skill and experience required of them. And in this section would normally contain reference to billing as work progresses. Next is the current time audit. Next slide, please. Seven is the current time audit. Here, there might be a statement here that the terms of engagement letter would be effective for the current and future years until such time as circumstances change. And the last is the eighth one. Finally, 2 copies of this letter of engagement would be sent to the management, the addressee, with the request that one be signed to indicate agreement and return to the audit firm. Next.
Okay, that's our presentation. Thanks for your attention. And if you have any question, you can ask us. Thank you. Wassalamualaikum warahmatullahi wabarakatuh.